Hello, my name is Blayne Andersen. I'm an investment professional at BANDER Investments. Today I would like to provide an economic commentary and specifically address the tariff wars' current and potential future impact. This is something that has come up often with clients of late, and I would like to share a few data points as well as an update. I will provide information today and we'll reference commentary from Robert F. DeLucia, CFA and consulting economist for Members Capital Advisors, as well as references from my weekly economic update as of August 12th. Following growth of 3.1% in Q1 of this year, U.S. real GDP expanded at an estimated annual rate of only 2% in Q2. The slowdown can be attributed primarily to the effects of the escalating tariff war with China. Another factor at work, strong growth in household and service sector spending was partially offset by a weakness in manufacturing and business investment spending. Although the current U.S. economic expansion is the longest in American history, beginning in 2009, it still is subject to a basic principle of business cycle theory. Expansion cycles do not die of old age, but rather because of spreading excesses and imbalances within the economy that undermine the economy's natural tendency toward growth. I would like to provide an economic review and data points from 2019 at the halfway point, as well as an outlook for the rest of the year. Here are some of the highlights. Hypothetically, in absence of the current tariff war, U.S. economic growth during 2019 would be closer to 2.75% rather than the current pace of 2%. World GDP would be significantly stronger at 3.5% versus its current 2.5% growth rate. Second, business investment spending has been a major casualty of the trade conflict and would likely be much stronger in a non-tariff environment. Businesses have postponed long-term investment projects because of the enormous uncertainty surrounding tariff policy. Sustainability of the U.S. current economic expansion cycle is dependent upon U.S. trade policy and the speed at which typical late cycle supply pressures gather momentum. Robert mentions that he has recently adjusted his forecast for U.S. economic growth over the next 2 years to allow for the growing uncertainty associated with trade policy. The U.S. and world economies will weaken progressively the longer the tariffs remain in effect. Because of these trade tensions, his forecast now assumes slower GDP growth over the next several quarters. The odds of a recession during the next year are well below 50%, but would rise with an escalation in tariffs. I also expect that the business expansion cycle will be sustained for a longer period, assuming China and the U.S. agree to a satisfactory resolution of trade tensions prior to year end. The implications would be extended business and earnings cycles and postponement of the next recession until 2022 or later. U.S. real GDP appears on track for growth of 2% during the second half of this year. An interim resolution of the trade conflict between China and the U.S. would lay the foundation for 3% economic growth during the first half of next year and 2.75% GDP growth for all of 2020. Diminishing inflationary pressures should also support a lengthening of the business expansion cycle. Core consumer inflation has declined from 2% 1 year ago to only 1.6% and is likely to stabilize at its current pace through the end of this year at a minimum. One thing you may have noticed recently is China devaluing its currency. Stocks fell 3% in reaction to the overnight weakening of the Chinese yuan. A weaker yuan makes Chinese exports cheaper for buyers who pay for them in dollars. Critics quickly accused China of manipulating its currency to strike back at the U.S. The federal government plans to impose tariffs on nearly all Chinese products next month, likely making those goods more expensive to American consumers. A weaker yuan could counter the effect of those import taxes. Also, as an earnings seasons update, 90% of S&P 500 firms have now reported second quarter results. Their collective sales and profits have surprised to the upside. Stock market analytics FactSet says that the overall earnings have beaten estimates by 5.7%. 75% of firms have reported actual earnings per share surpassing estimates, which is better than the 5-year average. As a final thought, we are seeing a significant bond rally this summer, even with interest rates at very low levels. The 10-year Treasury stands in contrast. Friday, it was yielding 1.74%. And if I may, I would like to provide a tip when it comes to saving for retirement. If you think you need to save more for retirement, think about saving at a rate that is slightly above your comfort zone. This calls for some financial discipline and dedication, but your future self may thank you years from now. As a standard rule of thumb, we often recommend to investors and clients that they save between 10 and 20% of their income. You may have heard the old adage to pay yourself first. I hope you've enjoyed this economic commentary and update, and look forward to talking again soon. Thank you.